Okay, well, thank you for joining us here live from KraneShares headquarters in New York. Welcome to KRBN Volatility, the tale of two carbon policies. We'll be getting into the weeds on what has driven some carbon price action over the last year, which a lot of us have been watching very carefully, but more importantly, where a carbon price is going from here. And I can assure you this is going to be an opportunity to invest this year that we will look back to this webinar, remember this pivotal moment in carbon prices, because we really are at an inflection point, and I think that inflection point is going to be very useful for those that join us. And so, as always, we're going to introduce our speaker, Oktay Kurbanov, who is a partner of Climate Finance Partners, CLIFI, and is also former quant at AQR. And when we get into the models that we're going to show you on carbon prices, I think you'll be able to see exactly where that quant background comes into play. So if we could just pop up the slides here, we will get into the presentation. And remember, if you're watching this on Zoom, you can put any questions directly into the Q&A section within Zoom. If you're live streaming this from our website, please use info@KraneShares.com to send us any questions. We usually get quite a few questions, so please do that. We will answer them. It will be Q&A section in Zoom or info@KraneShares.com for any questions. And if you want copies of the deck, any other questions after the fact, info@KraneShares.com. And of course, we offer CE credit for this session. So please send an email to ce@KraneShares.com in order for us to process that and make sure you get credit for attending this session. So KraneShares, we're very well known in the space for both China and EM, as well as climate and carbon, and these really form the core pillars of our business. So today we're going to focus in on we like to pick our areas of specialty as being some of the more high octane, interesting markets, and we think is going to be very powerful for portfolio allocations in 2024. So with that, I'm going to move on to our first slide as we kind of get into the meat. And I should say, actually, if we do go back one, I missed an important thing. We do post updates on the carbon market every single week, and there's a barcode there, QR code for you to scan that will subscribe you to Climate Market Now, where we're giving ongoing updates, as well as the KraneShares website, where we produce quarterly reports as well as monthly articles on carbon markets. So lots of content out there. I think we're the home of accessible carbon information and research, so please join us there for ongoing updates. So without further delay, I'm gonna dive in here. So first and foremost, when I talk to clients about carbon, I'm always sort of back and forth, swinging, the pendulum swings. Do I talk about the impact? Do I talk about the economic story? And the answer is it's both. And oftentimes all audiences are receptive to economic stories, and some audiences are receptive to impact stories. But it is worth noting why carbon pricing is important and why this will be an unstoppable economic force as the greatest policy tool that global governments are deploying in order to put a price on carbon and therefore create the economic stimulus to reduce emissions. So right off the bat, I want to be really clear. When we talk about carbon today, we're not talking about forestry projects. We're not talking about ocean projects. We are talking about policy carbon, a government mandated price on carbon that creates this slew of economic environmental changes, the invisible hand of capitalism that will reduce emissions and create more innovation into a low carbon future. This is the catalyst that you can be long. So why is this happening? The data is just undeniable. It doesn't matter what you believe is the cause of global warming, but there is no doubt, as you can see with these two charts, that on the left, we're taking monthly, each year, we're taking an average temperature of each month, stacking them up. You can see that 2023 was off the charts, quite literally off the charts of all historic data. Now, there was an El Nino year. It was particularly hot, but this hasn't ever happened before. And you can see that if you look on the right chart here, the pre-1950, you had a much broader and lower range of averages. Yes, it does change each year, fluctuates up and down, but you can see through the 70s and then the last 15 years, it's going almost exponential. So if you plot the average temperature each year, we are rising at an incredible rate. And The article that this came from talked about scientists running out of words to use to describe. Is it absurd? Is it terrifying? We really are experiencing unprecedented temperature changes. And as a result, there will be policy changes to control that and seek to find alternative ways to create energy, create cement, steel, power, and so on. So this is why we're here. So what is the price of carbon? What is a carbon compliance market? If we move to the next slide. This is, and I know a lot of the audience today, we see the names of people that join us, people that are investors, and a lot of you know this, but for those that are joining for the first time, I'm just going to spend a couple of moments here explaining what this compliance carbon market is. Simply put, major governments like the European Union, like the UK, like the state of California, the top 10 global economy in its own right, the power stations of the northeast of the US have created carbon markets where they issue a capped amount of carbon credits each year. And those credits are then must be bought by the power stations, the cement, steel, glass, agriculture companies within those locations in order for them to pollute. So if you pollute 10,000 tons of carbon, you must buy 10,000 carbon credits and return those to the government in a similar way that you have to pay your taxes to the IRS. And it's managed, audited, and enforced in much the same way. So what they do then is reduce that cap over time towards their future target. So if you have a 50% reduction in greenhouse gases by 2030, you have to work out a linear reduction factor to bring that cap down to 50% by 2030. Now, what that does, it doesn't tell people that they're not allowed to pollute. It doesn't tell people what to do. It doesn't favor any particular industry or country. What it does is tells those companies that they will have to now optimize. They optimize for their natural resources. They optimize for their real estate. They optimize for their fuel. They optimize for their staff. Now they have to optimize for their pollution. That's all it is. It's bringing inside this negative externality of industry and makes the companies have to fight for a correct price of that carbon. So by bringing this down, we're going to reduce carbon. By bringing this down, we're going to see higher prices, and those higher prices is how you get the catalyst. What's important here, and if you look at the chart, we've got a you are here arrow. We are at the inflection point, both in Europe and California, the two largest markets, where the supply of credits is now hitting that inflection point with the amount of demand, i.e. pollution. So historically, these markets were easy. They were easy to access and supply was abundant. We're now moving into a more scarce environment. And that's when A, prices move higher, which is why we like the investment story. And two, prices moving higher catalyze a reduction in emissions and a boom in green innovation. And that's why we like it for the impact. So we can go to the next slide. This is the marginal abatement cost curve. And this is published by Goldman Sachs in their Carbonomics paper. There are other versions of this out there, but we like this one in particular that shows that the price of carbon will move along and attack each form of pollution, starting with the lowest cost up to the highest cost. So at the low end, you can imagine it's power stations switching from coal to gas. And at the higher end, it's aviation, it's farming, it's steel and cement manufacture, some of the highest polluting and most expensive forms of pollution. And so you can almost imagine that the price of carbon will rise along this curve. Today, the average price of carbon in our fund is about $40 a ton. So as you can see there on the axis, the first notch is 100. So we're right down below that first notch, and the price should trade up that curve as we mitigate more and more carbon and the global economy. Now, this suggests that the price could get to $1,400 a ton. That's a little too ambitious. Why? Because if we went to $1,400 a ton, today we'd have incredible returns, but we'd actually disrupt industry and disrupt emissions because of disrupted industry, not because of actually finding technological improvements. The objective here is not for us to go back to the Stone Age. The objective is for us to have all the power, all the produce, everything that we have today, but at much lower carbon emissions. So what will actually happen is as you go up this curve, the curve will start to flatten as innovation brings down the cost of switching from fossil fuel to a renewable alternative. So there really is a huge impact and a huge upside, economic upside opportunity with the compliance price of carbon. And we kind of pat ourselves a little bit on the back with our suite of three main funds: KRBN, which is the global; KCCA, which is California; and KEUA, which is Europe. You can see there the tonnage of carbon in our fund is about equal to 3.6 coal-fired power stations, or $2.6 million homes annual electricity use, or 3 million gasoline-powered cars. So our fund alone is holding up and storing off the market a huge amount of carbon already. And as we grow this fund, not only will it store more carbon and tighten that market further, therefore driving prices higher, we're going to have an incredible impact. But of course, the tail doesn't wag the dog. If we go to the next slide, this is something like an $800 billion market. So we talked about impact and moving up this cost abatement curve. I just want to kind of really bring home this point about impact. There are three powerful impacts that are created through this program. And that is that, one, you have an auction revenue. So by selling these credits at auction, which is how these markets work in the primary sense, they create this revenue that is then put towards climate initiatives. Secondly, you put a price on carbon, you suddenly start to change the economics of different fuels. So you can imagine fuel switching is that kind of base case here. You're burning coal. Coal is twice as dirty in terms of carbon as gas. So you have to buy two credits versus one credit for using gas. So as the price of carbon goes up, even though gas is the cheapest fuel, you start to handicap coal versus gas. And at some price of carbon, approximately where the price of carbon is today, it becomes cheaper to burn gas. And so you see power companies switching from burning coal to burning gas. They're halving their emissions simply because there's now a price on carbon. So that's kind of the low-hanging fruit. People just switching to very easy and cheap to convert processes. And then on the higher end, you have this, and this is my favorite part, the accelerating innovation. As the price of carbon rises, you suddenly put a value on green innovation. If you can make steel with less coal, if you can make glass with less heat, if you can make agriculture or dairy farming, there's so many innovations occurring now simply because there's a price on carbon. Because historically, reducing emissions was a nice thing to do, but there was no money in it, therefore it didn't get any investment. Now that there is a price on carbon, there is a tangible real price or value in reducing emissions in industry. And so there is an arms race. There is a massive flow of capital into various industries, in fact, every industry, to try and find ways to reduce emissions. So that's sort of the invisible hand that I talked about and why that curve will flatten over time. So we can look forward to finding the solution simply because we have a rising price on carbon. So if we go to the next slide.
Actually, look, I want to add a couple of things on the previous slide, just to get a sense of the magnitude of the numbers behind revenues that the governments are earning using this emission trading systems. In the European Union alone, the government raised 150 billion euro since inception of the program. And in 2022, it was about 39 billion euro. In California, it was 22 billion since the inception of the program and about 4 billion per year in the recent years. So that gives a sense of the implied government support for the stable level of prices in this market and vested interest in the price gradual appreciation over time to be able to finance this energy transition program. And another notable event happened recently in Europe. The European industry representatives had a meeting where they asked for greater government support to help energy transition, which they called European Industrial Deal. And that comes on the tails of the tough performance of the industry last year, where we saw some demand reduction leading to some struggles in the industry. And these programs will provide vital support for the funds to help energy transitions, which again highlights the importance of maintaining the steady price levels and gradual appreciation in these programs. Next slide, please.
Thanks, Oktay.
Yes. In the following slides, we'll discuss the price trajectory of this markets and the opportunity that we are facing right now in terms of the entry point and the upside appreciation in the markets. But before we get there, I think it's helpful to discuss the background and trends and themes that were unfolding in this markets and the catalyst going forward. And as we will see, the same themes that presented headwinds for the European markets, we expect to be the ones supporting them going forward as they go through their natural cycles. For example, one of the major topic in these markets was the REPowerEU initiative, which was the government-led initiative to help finance energy transition of Europe toward energy independence. And the way this initiative unfolded is by using auction revenue, bringing forward front-load auctions from future years to years through 2026 to help finance the transition. And the key point here is front-loaded, meaning that in future years, starting from 2027, there'll be less allowances auctioned, which will be the flip side of the trend. Another major theme in this markets was the final approval early last year and the implementation of Fit for 55 market reforms that will lead to a major tightening of these markets later this decade. That will be a theme that will be unfolding over multiple years. It's a longer term play, but we'll see more and more of that coming into place in the later years. In terms of the tailwinds for the industry, we saw the power emissions declining 20% last year, and the industry emissions about 5 to 6% on the background of the economic downturn. European economy dropped its growth from 3.6% in 2022 to 0.7% last year. But as all economies go through the economic cycles, based on the latest predictions from IMF and other economists, the economy will start turning around this year and getting back to the trend growth in 2025, 2026, which will support the carbon markets as the demand for emission allowances will increase. And finally, just thinking about the policy objectives, in order for Europe to achieve its carbon neutrality goals by 2050 and to hit its newly established goal of 90% reduction in 2040, there'll have to be abatement measures put in place in the industry. And you cannot have it, you cannot make it economically feasible when prices are around 60. The prices have to go the other direction, above 100 euro to 150 or so range by the end of the decade. And that's another policy objective. And as we often see in this market, the policy objectives often translates into measures that tighten supply and provide price support. In California, we've seen a strong regulatory support over the last year with multiple webinars implementing a new ambition of a 48% reduction of emissions versus 1990, which is an upgrade from the previous goal of 40% reduction. There were also additional measures to address excess supply in the system. All those measures led to expectation of tightening markets, which in turn led to the support of prices. And as we'll see on the balance, these measures will see the tilt of the cumulative balance from increasing to a decreasing trend, essentially showing that we're now at the inflection point in the California markets where we'll see the market getting into net deficit over later years in the decade.
I was going to add, Oktay, just before we dive into the individual markets, and really we're going to focus on Europe and we're going to focus on California. We have a single standalone product for each, and then our blended KRBN is 60% Europe, 30% California, and then 5% each UK and REGI, which is the northeast of the US. I just wanted to, just for those that are sort of first time around listening to this, I want to make a couple of points right up front, maybe that just to set the scene and the context. These are government issued assets that have a natural demand, a physical demand from all industry in those geographies, Europe, California, and so on. And then they have a managed supply that is structured to be in a tightening cycle. So think the Fed. This is the Fed instead of trying to bring down inflation, it's trying to bring down emissions. So they will be on this single tightening cycle until we reach these carbon targets, these pollution targets by 2030, 2040, and 2050 and beyond. And so think of this as something that has a very material value. It is backed by, a Fed of sorts. So it's almost, if you think about the don't fight the Fed analogy, this is an asset that is being, by design, structured to rise in order to create the innovation and transition away from carbon intensive industry. So that's what all of this is about. And prices are the mechanism, or are the implicit mechanism. The direct mechanism is the managing of supply versus demand. So that's when you think about what makes carbon prices rise, it's when the supply is tightening faster than pollution is reducing. And when are these prices weaker? It's when pollution is falling faster than that scheduled tightening in the market. And that's where this Fed, so-called Fed of carbon, can come in and manage supply. And they do that through policy making. So I just wanted to kind of bring that in because maybe we didn't talk about that quite enough so far, but that will hopefully frame the context of the demand and supply dynamics that we're going to talk about for the rest of this. So sorry to interrupt, Doc, there, but I thought that was worth touching on again. So please.
Yeah, great points. Next slide, please. Yeah, so getting back to the actual price trajectory, this year, European prices declined by 30%. And if we look at their performance since their peak in February last year, it was about 45% decline. And I would say there are three major reasons behind that. The first one, when we mentioned this REPowerEU initiative that brought extra supply that was weighing heavily in the market. But I would say the bigger reason is the economy. The news of lower emissions were coming through the year, and the market was reacting appropriately. As I mentioned, the power and industry emissions were just going through the regular down cycle. But what we observed in this market, very often the market players react to the events happening at a given point in time without looking forward to the next 2 years or so when the economy is expected to rebound, which will push the demand for emission back up. So the same themes as push the market down expected to turn around, as we mentioned. There was another theme that we'll discuss later is it seems that there are CTA, more tactical financial players in the market that may believe in the long-term fundamentals of the market, but want to capitalize on the shorter-term trends, in a way amplifying the recent downturn. But again, with our discussion here, the same players, as they turn around, will amplify the reverse path of the price going up later, as we expect this year and the following decade. Okay, next slide, please.
So I'll take this one. So the Fit for 55 package is the rollout of Europeans' tightening policy around this market. So the market's existed for over a decade, but this last few years, since about 2019, they've introduced this powerful slew of dynamics. So one of them is that the major tightening improvement on that curve. So the program is set to increase from a 2.2 linear tightening factor to a 4.4, meaning that we're going to be tightening each year twice as much as we had previously been scheduled. The other huge impact here is called the Market Stability Reserve. So not to give you the whole history of the markets, but around 2008, 2009, we remember what happened then. There was a huge drop in economic activity, which meant less pollution, which meant they actually built up a glut, an oversupply of these credits. So it took until 2019 for them to actually get a handle on that oversupply, because the market was actually oversupplied to the extent that it wasn't going to tighten up enough by 2030. So they introduced the Market Stability Reserve. What the Market Stability Reserve does is, if the market inventory of these assets of carbon credits is greater than 833 million tons, then the Market Stability Reserve will take down 24% out of the auction each year. So in addition to the 4.4% linear tightening, there is a special 24% tightening that's happening every year until that surplus gets below 833 million tons. So just to give you some context, the cap is about 1.5 billion tons auction per year. That's dropping by 4.4%, but also 24% of that is going to the market stability reserve, which means that companies are going to have to use their inventory. So that market surplus that exists is being run down, and that is the real driver of the tightening market. The cap is already quite aggressive. It's getting rid of that surplus, and we're in that transition of the surplus being run down, and that market stability reserve is the main driver of that, and that is the main driver of tightening. So that's one to watch very carefully. And just to give you some context, we're about 1.3 billion tons of surplus. So we've got quite a way until that gets down to 800 million. So there's a lot of tightening that we're going to see over the next few years. Secondly, within that, you've got CBAM. Oktay is going to talk about that a little bit more. That's the cross-border carbon border adjustment mechanism. So I'll leave him to get into the juicy part of that. But essentially, it's Europe exporting this price of carbon to any country that wants to export into Europe. If you want to sell goods in Europe, you're now going to be in this program, not just companies that pollute in Europe, but those that want to export their high carbon products into Europe. And also inclusion of maritime. Maritime is a huge polluter. That's shipping. Shipping coming into this program is going to be another big industry that gets added. And by tightening up shipping, we're going to reduce emissions greatly. You're also going to have a lot of credits being traded by those shipping companies. And also free allowances are going away. So what used to happen before the CBAM, the border adjustment, certain industries would get protection from the price of carbon because they were, German steel, for example, might not be able to compete if they're paying the carbon price and there's cheaper steel imports coming in from, say, Asia. Now that there's a carbon adjustment price being put on the Asian steel importer, it makes it takes off the pressure off the German steel company. So the German steel company has to buy those credits. So if you imagine two people now have to buy the credits, where previously none of them were buying these credits. So that's another huge improvement to the program. And then REPowerEU, I'm going to get into the detail on that because that is the single, in my opinion, biggest driver of why prices are lower right now and why they will come back in the coming year or so, is because REPowerEU was a reaction to the Ukraine invasion. If you remember what happened in Europe, we had Ukraine, which was, and natural gas supply from Russia into Germany and others became heavily constrained as a result, and that pushed gas prices through the roof. It created energy crisis in Europe. It created, whole industries couldn't afford to operate, chemicals, steel, and so on. Fertilizer and other critical industries could not operate at those prices of natural gas. So we had this strange scenario where people were burning more coal, which is more pollution, but then you had people doing less business because they couldn't operate their companies on elevated gas prices. So you had this kind of, you might remember from Oktay's chart a moment ago, you had this range bound 80 euros to 100 euros price of carbon that we fluctuated in because every headline was worse pollution, less pollution, worse pollution. What Europe did, and it was very clever and it was very good policy making, was, and in fact, how about I wait till we get to that slide, Oktay? I don't want to jump ahead. Maybe if we go to the next slide, I think this is my slide. So REPowerEU, if we talk about Fit for 55, and in fact, I already saw one of the questions that have come in. Somebody said, if this is supposed to go up, why did it go down last year? Great question. So the Fit for 55 that I talked about was this holistic range of European tightening measures, which was set to manage this price much higher in a stable way to catalyze the creation of new innovation in industry, as well as bring down emissions. However, a few things happened. So we had this invasion of Ukraine. So REPowerEU was the policy that came in. So if you imagine Fit for 55 was designing this carbon market to basically go up in a structured way, REPowerEU was a very well thought out mechanism for easing power markets during the Ukraine crisis. Obviously, we're not out of the Ukraine crisis, but the first year or so was definitely a much more heightened volatile period with more uncertainty around power. So what REPowerEU did was address the fact that carbon credits were going up over 100 euros prematurely. Natural gas prices had gone up 400%, so they weren't able to, as I said, a lot of industry was being very heavily affected by that power shortage or power expense. So REPowerEU said, why don't we find a way to ease the carbon markets, but without permanently easing or permanently undermining this market structure, because ultimately prices need to be much higher and we need to maintain this upward trajectory. So after lots of debate, which also caused volatility, they decided on something very clever, that they would not increase supply in total, but they would move forward future auctions to the near years in order to ease at the front, but with extra tightening in the back. So as a financial thinker, and probably most of us on this call are financial thinkers, you would actually view that relatively neutrally, because the net supply over time was the same. These aren't commodities, right? These are financial assets. You can store them indefinitely. They're cheap to transfer, and they have a liquid market for these credits. Unlike a commodity like oil or power, where storing is either impossible or incredibly expensive, they trade more on a clearing spot price rather than priced based on future expectations. So if you have more auctions today, so what they did was they brought forward 100 million tons per year in 2023, 2024, and 2025, and they'll have 100 million less in 2026, 27, and 28. So as a financial modeler, you would take those things and say, well, it's roughly net neutral, plus the market stability reserve, which takes out 24% of surplus, will see more surplus in these front years and take that out. So actually, this net might be a tightening measure. However, because of and Oktay mentioned this, the sort of short-term trading, the trading houses, and also the sort of power and gas traders that are trading carbon hedges alongside their power and gas, you actually see carbon trading, very short-term thinking, and not long-term financial modeling. This creates great opportunity. So what happened? We had all this long-term structuring to tighten the market rapidly and over time. And then suddenly they front-loaded some auctions. So what you had was not any easing, but you had less tightening at the front, less tightening than we had originally forecast, and then more tightening in the subsequent 3 years. So as a result, we kind of modeled this, and so did most of the research houses, that this should just mean softer prices for a couple of years and then continuing to rally thereafter. But the shorter term mindset of the trading community was this reduction in tightening is actually a shorting opportunity. And we actually saw a lot of selling of these positions in the short term, while full well knowing that they will be going long again in the future. So we've noticed that the known future changes tend to not be priced in until about 18 months before they happen. Even though we know they're going to happen, the market tends not to price them in. And we spent a lot of time on California that we'll talk about on that one in just a moment. But Europe right now, because of REPowerEU injecting extra supply now and taking it back out in the future, is giving us some soft prices in the short term. So when we get to the model slide, it's my favorite slide. That's the one I want to show you, why we think this is creating an incredible buying opportunity in the price of carbon today.
I want to add just a quick comment. There are questions about the green backlash. I think these 2 slides might be a good opportunity to discuss that. Essentially, the European government definitely is concerned about the green backlash, and this was a smart way to relieve price pressure on the markets by injecting this extra supply now without compromising the system integrity. There is a little subtlety that they also added to replenish the innovation fund by tapping into 10% from the market stabilization reserve in later years. And what I read, part of that reason, again, to send that signal to the market, we're relieving pressure on the industry. Let's just go to the next slide, which is CBAM. CBAM is another illustration where the regulators are implementing the program in a smart way to not put undue pressure on the industry. And let's just discuss what was before CBAM, before we get into the CBAM discussion. Before CBAM, the governments were protective, and they are protective on the industry, on the concerns of their competitiveness and the risk of losing industry by companies relocating overseas where they do not have to pay this carbon allowance price. So the industry sector was getting essentially free allocation covering up to 80% of their operations. So they don't have to buy them and they can just use to satisfy their compliance requirements. And the government would not just take that away. At the same time, it was foregoing a large chunk of their revenues. So what they decided to do is to level the playing field, and as Luke mentioned, to start collecting, in a way, carbon taxes on importers of carbon-intensive goods. So there is a steel export happening into Europe, and it costs a lot of carbon to produce coming from China, where there's a lot of coal power, or from Indonesia. The European government will start collecting tariffs on those embedded carbon-intensive imports. And that system goes into place 2026 and gradually ramps up to be 50% in scope by 2030. So it's going to have a major impact. In parallel, given that the playing field is being essentially more level, the government will start reducing free allocation to the industry to synchronize with the introduction of CBAM. So essentially, they're trying to balance their green initiatives with the relief for the industry. And the benchmark will also decrease to about 50% by the 2030. So the industry will still be getting some allocation. But essentially, free allocation will go to zero at some point, and CBAM will go into full force later in 2040 or so. There are three major implications of introduction of CBAM. One is that the governments around the world that are exporting into the European Union will have accelerated creation of their emission trading systems in order to avoid this tax. The tax essentially is payment on the difference between the European price and the emission trading system in respective countries. So the countries would rather charge their companies and keep that revenue to themselves versus just that money going overseas. Another impact on the EU ETS is potential hedging demand by industry players in Europe and potentially new players that are exporting to Europe. In 2022, the embedded carbon was about 200 million ton. So that accounting for about 50% hedge ratio through 2030, it will translate in about 90 to 100 million ton additional hedging demand that might be coming into the system, which will provide support for prices going forward. And finally, as free allocations are going down, the companies will have to go to the market to buy those in the open market, which will induce more trading, better price discovery, and higher liquidity, which should also be positive for these markets. Next slide, please. Here we analyze the positioning of financial players in this market, so categorized as investment funds. What we see here that for some time through maybe the middle of 2023, the positioning was fairly stable with the net position about 10,000 contracts in the space, fairly stable longs and short. As the headwinds in Europe start appearing mid-year, or what we see that the overall positioning became net short. However, if we dig into the long and short side, we see that the long players maintain their positions, which may indicate the optimism over the longer term outlook in the market. However, on the short side, we see a fairly rapid deterioration to the short positioning, which may indicate that the more tactical players want to take an opportunity over the shorter term trend and just make some money on the way down. But as we discussed, as the fundamentals turn around, as the upcoming deficit in the later years will start being on the horizon for the industry players, we expect this this position may turn around as much and to support the price on the way up to amplify the trend.
And Oktay, on that, I mean, it's worth noting that the exchange publishes a categorized summary of longs and shorts, and we can absolutely see that the investors are building longs or are still long, whereas the short-term traders are those that have gone short. Those traders are sometimes long, sometimes short. They have been in a short cycle for much of the last year, and we're about to show you why, or hopefully we've sort of explained a little bit why. But it's that short-term trading that has pushed prices down over the last year. You know, we're trading around 60 euros per ton of carbon from highs of around 100. So should we go to the next slide and look at the model?
Yes,
yeah. Oh, sorry.
Yeah, you're right. Yes.
Yeah. Well, so this is the European model. Now, this is Oktay's model with my notes added around it. And so we'll both probably talk to this one. This is my favorite slide. If there was one slide I could show you, it would be this one. So remember, Oktay mentioned there's about 3 reasons why we've seen weaker carbon, European carbon, over this past year. One is some economic slowdown. 2 is we've had the actual REPowerEU has been successful. We've seen a big switch towards renewables. And then, but thirdly, and most importantly, in my opinion, it's that REPowerEU shifting supply. And probably it's a little bit like, I keep going back to this Fed example, it's a little bit like Jerome Powell raking heights too quickly or cutting rates too quickly or too late. There's policy that's right, but the timing and the magnitude can sometimes be off. So we think REPowerEU was very well done in that they didn't break the market. They didn't inject false supply or artificially take supply out. They simply shifted the timing, which should have been relatively neutral, but it wasn't. Why not? So let's look at this curve. So the top line, the purple line, is this cap coming down. So that is their top line ambition to reduce emissions. So you can see that tightening. It's got steeper and steeper over time. We suspect it will keep getting steeper. And that's our sort of base case for a rising price of carbon, that it becomes, the cap comes down, the market gets tighter, therefore the price gets higher.
However, just to get a sense of the magnitude of this relative to this supply in the years 2003 to 2026, it was about 6% of extra supply coming to the market. So naturally, the market reacted this way. But the same way on the way back, it will be 6% reduced in the later years, which will be the flip effect down the road.
Yep, exactly. And so the purple line is the reducing cap. The black line is the surplus in the market. So if you remember, early in these programs, they oversupply the market to create liquidity, to create inventory, to make them easy to buy, make them low cost to buy. Once these are adopted, they then start tightening the screws and start managing the emissions via the cap on the carbon. So even though the pink line, the purple line, the cap going down is sort of a headline tightening, the thing you need to watch is the black line. How is that tightening? Because that is where the rubber hits the road. That's how easy or tight the market is for participants. So we had, and Oktay will tell me off sometimes that I oversimplify things, but I think it's okay in this case. You see that the dotted line goes down in a rather linear point. So I don't know if you could see there where the circle is. From the beginning of the circle until 2030, I put a dotted linear line. That was roughly the tightening schedule that we were on. The market was going to tighten all the way down into 2030, and the price was going to keep rising all the way to 2030. With REPowerEU, they brought some auctions from 3 years at the back to 3 years at the front. So what that caused, it wasn't easing, but it meant that the curve sloped down, flattened, before then it steepened again back down to its trajectory. So by 2028, we're back on schedule. But it means between 2023 and 2028, we have a flattening followed by a tightening. As I mentioned, and this is hopefully the graphic that kind of highlights this, if you're pricing the future, you should net all of those assumptions out and come back to, here we are today, here's where I think it's going, I can discount that back, and that will tell me what today's price should be. Instead, those short-term traders that Oktay showed us had all gone short in the last year. They are trading what's in the circle. they are trading the fact that the curve is flat now or flatter. Therefore, the market is easier than had originally been forecast. Therefore, prices should be lower. And we've seen this sell-off. However, those same shorts, as well as all the longs, all know that at the end of that circle, the market rolls over and we go into tightening. And as I mentioned, anecdotally, we see the market pricing these known things. It tends to try and trade short term until we're a year and a half away from an event, and then we start pricing in the event. So I think this is really important that while we are in that circle, we have experienced this soft pricing, but we are about 18 months away from that curve rolling over. And so we want to now start building our long positions that we've been given the opportunity to get in the sort of 55 to 60 euros per ton as the market goes back where we think it's going back to. In fact, if we go to the next slide, we'll show you the forecasts. Forecasts are pretty much unchanged. These are forecasts that have come out since the sell-off. So if you look at these are the main players. Actually, that you might not know all of these names, but these are all the main research houses in carbon. Of course, Macquarie Bank and Bloomberg New Energy Finance, very well-known names, and ICIS, VATE, and Energy Aspect, very well-known in the environmental space. They are all forecasting 70 to 90 euros a ton in 2025, over 100 in 2026, and then these sort of mid 140 to 180 by 2030. So we today, where we were trading in an 80 to 100 range, all of 2022 and part of 2023, we're now able to get in at about 60 euros a ton. So many investors said, well, I wish I could, if this ever went back down to 60 or 70, I'd be a buyer. So conscious of time, let's keep moving. But that's Europe. Europe has become, over the last year, perhaps our biggest opportunity. We always were most excited about California, but now we're as equally excited about Europe as we are California. So let's go to California.
Yeah, just switching gears to California, the prices went up about 30% last year, which was supported by a strong regulatory process with multiple webinars with specific confirmation of the new targets, and the legislation process with specific design of how the caps will adjust to accommodate the new policy. This year has been flat as the market is anticipating the legislative process to complete this year, with the new law coming hopefully in 2025 to solidify this trend. And the indication of the market enthusiasm is the recent auction, where the settled price was the record high level, 41.76, which was fully sold out with high bid coverage ratio. Next slide, please. So this is a similar slide showing the cumulative surplus in dark, and just listing the cap just to compare its relative size. As we discussed, the market is currently at the inflection point with all the regulatory measures projected to reduce supply in the future years. And this is a typical arched directory of the emission trading markets, where it starts in a relatively loose way to allow industries adjust to the explicit pricing of the greenhouse emissions. But in the later years of the system, the market tightens up to incentivize the transition, generate revenues, and accomplish the policy goals. And the tightening is pretty significant. It's about 20% or so of the outstanding supply, and it could be higher as the legislature considers measures to explicitly remove excess from the system by using either reserve or just reducing future auctions. So we're very optimistic of this market, and now it's this good time to position investors for the upside in the future years. Back to you, Luke.
Thank you, Oktay.
Yeah.
Just stay on this slide for 1 second. We've been showing this slide to people for 2 years, and this rollover of the black line to us, just like it was for the Europe slide, was just a screaming opportunity to be long, strategically long between now and 2030, the California carbon. But yet the prices weren't moving. But finally last year they started to move. The 1 year number, it's up about 30%, 34% in 2023. So incredible returns. Now, for anyone saying, well, okay, so the move is happening, it is happening. There is still an incredible amount of that move still to happen, because, as I mentioned, people are waiting to price in what we know. And we can see here that we go down to negative. So we run out of surplus by 2030, maybe 2029. So that doesn't break the market. It just puts incredible price pressure on the market. So let's go to the next slide and explain why. So anyone thinking that, and I've just got to pop up here. Anyone that looks at this and says, "Oh my goodness, like Europe, California's up 30-some%. Have I missed it?" Look at this chart. These lines are California's floor price at the bottom, which is about $24 a ton right now. We're trading at about $42 a ton today. And then those three lines are two liquidity tiers and a price ceiling. All of these lines go up by CPI plus 5%. So all of these lines are moving up. And the bigger the number, the bigger it moves when you multiply it by CPI plus 5. So these ceilings keep getting higher. Now, if you realize that by our model, we run out of supply by 2029 or 2030, well, then if that happens, you're going to have to buy in the first liquidity tier until that's exhausted, and then you'll have to buy at the second liquidity tier. So even if we just take conservatively the first liquidity tier, price that out to 2029, 2030 by forecasting CPI, let's call it 3.5% plus 5%, we end up getting up into the 80s by 2030. Then if you discount that back by money market rates, you get back today to a price of about $66 a ton. Considering that tier is only at $56 a ton, we net present value California carbon, not a forecast, net present value is about $56 per ton, and we're trading at $42 a ton. So the buy today, between now and the next 18 months, we see this moving towards that 56, and then you have a CPI plus 5 type return thereafter until we move to the second tier, and that could be another 25% on that price. And so today at $42, if you look at the forecasts that are all based on this same logic, by 2030, Macquarie at 85, so that's 100%, BNF at 93, and even the state of California is saying that by 2035, it'll be at 145. So this is like Jerome Powell telling you where they're going to set rates in 5 years. This is California broadcasting the price that they think will be the price by 2030 and 2035. So let's go. So incredible, Europe and California, incredible opportunities. I'm going to fly through the products here so we can get to make sure we answer some of those questions. But if we go to the next slide, the investment case, I'm going to go very quickly if you don't mind. So here's the fund, right? This is a $700 billion market. It's not niche. It's a massive, liquid, efficient market. Trading on our products are on New York Stock Exchange, and then the Intercontinental Exchange is where all the futures trade that we hold. And I mentioned earlier, we're 60% Europe, 30% California, 5% each UK and Reggie. Or if you go to our other funds, you can have pure California or pure Europe. We go to the next slide. Risk return. These markets are volatile. This upside story is not risk-free. You do get volatility. Generally, we observe that the basket is about twice as volatile as equities, but returns historically have been about twice that of equities. And based on these dynamics that we're talking about, the forward upside should be consistent with that. So you end up with a Sharpe ratio similar to equities, but much higher return, much higher volatility. But what does that mean? Is that additive to a portfolio? If we go to the next slide, we talk about correlations, and I'll let you talk about that, Oktay.
Yeah, so while it's highly volatile, it does offer diversification properties by its correlation structure with other markets. If you think about adding carbon to your portfolios, the correlation with other markets is about 0.25. So it does add in terms of expected return and not increasing your overall volatility as much. But another key characteristics of carbon markets that they're not as correlated with each other. And the reason for that, these are not fungible markets. Each of them have its own regulatory framework that follows its own supply-demand dynamics, which is the same reason that it's not perfectly correlated to equity markets, because supply-demand sometimes driven by policy factors rather than just pure economy. So these are great contribution to diversified portfolios just because they have their unique dynamics we discussed in this webinar. And
so
yeah.
I was going to say we could even so the point is on the next slide you've got higher expected return, you've got high volatility, but because of the low correlation, so 0.3 to equities, you actually get a portfolio dampening. So you get a higher risk return when you add an allocation of carbon to your portfolio. So I think that's, you know, moving on to the next slide is the use cases that we hear from our clients and that we talk to clients about. I think that creates a real, you know, a sweet spot there that we've got. You know, we've got this performance story. The market is designed and structured and managed to move higher over time at above, explicitly in California's case, but implicitly in all the other markets, to rise greater than inflation, because it's only increasing in its impact if it's increasing in real terms. So we've got performance story. We have diversification. Historically have maintained very low correlations to equities. Therefore, even with extra vol in carbon, you get a dampening effect and a better risk return in a portfolio. Inflation hedge, we've mentioned that. Inherently in the price of carbon is an inflation hedge. So we've seen a lot of institutions looking at carbon as another way to be long inflation and protected against inflation, because California specifically goes up by CPI plus 5 every year. And then you've got the impact, which funny, a lot of you might think that would come first, but impact, the market itself is the greatest impact tool that exists. And by participating in it, we are helping liquidity and driving that price discovery, which is really going to drive that innovation and that reduction in emissions. And then as an energy transition tool, this is powerful. We've seen, you know, I think one of the questions was about ESG backlash. We've seen an ESG backlash. Not investing in power companies, in mining companies, in resources companies, it's been a bad idea. What's a better way to do that? Well, you maybe maintain your allocations to the equities, but you overlay the price of carbon over that, because inherently these companies are short carbon. If you don't hold KRBN, KCCA, KEUA in your portfolio, you could argue that you're actually short carbon, you're short this story. So we've seen some investors have an allocation of the sort of 4 to 6% just to neutralize as an overlay to carbon proof their portfolio. So those are the main use cases we've seen. And if we just turn over to the, you know, I mentioned at the beginning, we've got some great resources for you to learn more about. Please scan the climate market now and sign up. We have all of these papers and documents that, you know, either myself or Oktay or members of our teams put out. And if I just turn it over to the obligatory ticker list of products, KRBN is our global, so that picks up the whole story. KEUA is just Europe. KCCA is just California. And while we digest that, we'd love to get into the questions and try and keep us on schedule. We will go longer to finish the questions, so we're happy to do that. So maybe, I don't know if we want to dive straight in here, but maybe I'll pick one up and send it over to you, Oktay. So we covered why the markets fell over this last year. We talked a bit about the green backlash. I think you kind of answered that one. Right. Is there any plan to change the upper and lower limits for the market stability reserve in 2025? That comes from... I
did see some suggestions that it might change in Europe, and we discussed about this balancing backlash versus the political will. There are many levers for policymakers to ensure stable appreciation of prices. This might be one of the levers, depending how market reacts to other events. When the economy turns around, what will be the market, where the market level will be at? Potential lowering of the 833 to some lower number could be one way to address the excess supply of for example, the energy transition is too fast. They don't want that either. They did not want the price decline. So it's just one of the levers. And the timing on that, I heard there will be elections in 2025. And I think until then, unlikely there'll be new major proposals. But after that, this could be one of the proposals.
I think I would agree with you on that, Oktay. I think there's lots of scope for tightening. But then let somebody ask this question. Let's just touch on it again, because I think it's important. What is the risk here? Like we always say, one of the risks is the political risk. How do you view the risks of politicians getting involved and rolling back or undermining or making mistakes in these programs?
Yeah, I think the energy independence, given an expected trump card for like for climate ambitions, where it's not just do good for the planet, but also a security concern to ensure energy transition to green energy. Besides just energy independence, it's also like military, more stable, less concentrated power. So I think it had that boost that justifies the transition beyond other means. And as we discussed, the European government I think has done a good job as a balancing act to provide free allocations and subsidies through various programs, both internally for developed countries, but also for the peripheral European countries, such as Poland, to help in the transition.
Yeah, thank you. I'm going to take this one, right? The lack of updates on the continuity of the program for California after 2030 could generate some uncertainty around the market. What are your thoughts on this? This to us, and this we did a client event in New York with I probably shouldn't name the law firm, but the law firm that was heavily involved in writing the laws and consulting with California. And it was probably, to me, this is one of the most, one of the greatest reasons why you should be looking at this California market in particular, is there is some risk premium baked into this question, which is the way the laws are written is it's not overly explicit that the program continues through 2030. Now, everyone in the state of California, everyone at the California Air Resource Board, every lawyer that has looked at this, every carbon manager that speaks at the North American Carbon World that's in California in a couple of weeks, this comes up every year, and everybody is absolutely certain, positive, no shadow of a doubt that this program continues beyond 2030. And yet there is this lingering challenge to the program that what if it doesn't go beyond 2030? It's not in question. So the way this lawyer put it, and it was one of the best insights at the lunch, was the market is pricing it like it's a 50-50. Really, it's a 99-1. This is almost certainly continuing beyond 2030. And people are on the sidelines waiting for that to be confirmed. And that is just a matter of time before that is hard-coded into law or hard-coded into the minutes from the California Air Resource Board. So we are very high conviction that this program, California Carbon Program, goes on beyond. I mean, they have 2040 and 2050 targets. This is not something that's wrapping up in 6 years. So this is an opportunity that the part of the reason I think the price is still below that $56 a ton is because of that doubt. So there's a risk premium for you to earn if you invest today in this market. So hopefully that's a strong enough answer. It's we're very high conviction on that point. Well, I mean, this one's a quick one. Why are KRBN and KCCA seemingly going in opposite directions at the moment? I mean, simply put, KRBN is Europe and California, and we've talked about the fact that Europe was down 40% over that period. California was up 30%. So KRBN net, because of it's both up and down, because it's in both markets, was down 18. California was up 34% in the year. So that's why, like any basket, they move with what's inside them. The KRBN has Europe in it, has a 60% weight to Europe. So when Europe's down, it will be down. California is only California, so when that's up, it's up. So different products, they will behave exactly like their underlying markets, and that's the reason for that. One that comes up all the time, Oktay, and I just saw it here, was about essentially the cost of futures, and this is something we talk about a lot, and it keeps getting better, right? So the question, I can't find it here right now, but the gist of the question is, when you hold futures, do you have contango? If you're in gas or oil, it's very expensive to sit long oil futures. So the question always comes up, is it expensive to hold carbon futures? And the short answer is no, because they're not a commodity with storage costs. They're a financial asset. But Oktay, I know if we could pop the slide up there, slide 27, 28, here it is. Yeah.
Yeah, I think the story of contango, especially in California, it's a popular one in the market. Some people even make certain trades to take advantage of that. On the long side investors, there were periods of time where it presented a decent cost to maintain long exposure using futures, as you have to get into the future and essentially the cost, meaning even after you account for the cash carry that you earn on your cash investment, the combined return of the future than cash is still less than what you could get on the physical. However, as we observe the market over time, we see that if this effect has decreased over time, over the recent years. And it almost seems that there's some correlation with the popularity of the trade. The long trade was very popular in 2021 for levered players, and maybe that demand propped up the contango cost. There are other theories, Luke and I going back and forth all the time on that. But the bottom line that the contango costs, both on the individual markets, CCA, EUAs, as well as the index, got to below 1% level in the recent years, and which is a welcome news for investors who want to invest in these markets.
And Oktay, just to kind of often people say California's 600 bips. You know, it's very expensive. It's not. If you're levered, yes, but we're not a levered fund, so we earn back. The reason for the curve is mostly the cost of money, and we put on the futures and we invest in the short dated money markets to earn back that curve. So what Oktay's showing here is our net. So the net carry, so the cost of carry minus what we earn back, is this sub 1%. So that's very powerful. There really isn't a more efficient way to get long these carbon markets than using the futures at this tight of a spread. So sub 1% drag in doing that. Question, this kind of goes back to when we talked about why Europe was soft. You know, how much does Germany's economy play into this? You know, if we have lower emissions out of Germany, what does that mean for prices?
Yeah, you want me to take it?
Yeah, if you don't mind.
Yeah. Obviously, it's a downward pressure on prices if German economy does not rebound as expected. Yes, there's some downward pressure. I think in our view, it will just delay the recovery by some time, but that's a risk in all investments. We think that there's the light at the end of the tunnel as the economy should start rebounding at the end of the year and just go through its natural cycle to crank up the growth.
Yep. Yeah, agreed with that. And I think, you know, you mentioned there's green shoots there and we're starting to turn around, but also that, don't forget this central bank analogy. If we materially see lower emissions, the European Commission could tighten the market to address that as well. So you've always got that policy hand at your back as well. One question.
Just to mention, look up. There are two mechanisms. One is the automatic mechanism already in law, which is removing 24% of excess allowances from the market. So there's more excess allowances, more of them will be taking out, a quarter of them. And there are many levers from the regulators, as we mentioned, maybe starting from 2025 onward to just see where they want the prices to be. And I don't think they want the prices to be 60 euro when they were at 100 levels before, and when they need to be at 150 or so levels by the end of the decade.
And we'll get there. And so we're going to do a quick fire round here because there's a few more questions left. So one of them we got from Russell, talks about how are these ETFs impactful? I know that was a question that came in before the panel, so hopefully we answered it. But essentially, carbon pricing itself, so the compliance carbon program itself, is the most powerful policy tool for bringing down emissions. And by us and investors in our funds, you saw how big, how many millions of tons that we have in our fund. We are creating that price discovery. And by us buying, we talked about that black line that was the inventory. By us growing our portion, not just us, every investor, every holder of these credits starts to hold a portion of that. It makes that market that much tighter and starts to push prices higher. Not artificially pushing them higher, but actually creating the price discovery to where these prices. You need financial players like all of us to actually price in those forward values. You can't just have traders going long short on every piece of news. You actually need to reprice to the actual future fair value. That's absolutely critical. So that's the service that investors bring to this market. It's actually price discovery. Somebody asked, are we looking at Washington State? We are indeed. Washington State is a new market here. We're watching it very closely. We'd like to include it. It may join California at some point, and at the moment isn't quite big enough to be added to our fund. We look for about $10 million a month of trading before we'd consider it. So one to watch, something we're watching, not in the fund yet. No immediate plans to add it, but stay tuned to our content, and we'll let you know if we do that. Somebody asked about this market. KraneShares are the only big player in this market, so we'll take that as a compliment. But that's true. There are not a ton of options of other places to get this exposure for a retail investor. That's why we launched the ETF. So at an institutional level, there are all sorts of hedge funds and private funds that give access to it. But what was important for us was that we made this accessible, liquid, and easy to access. So that's why we're here. And it wouldn't surprise us though, as this market grows, if we get more competition. But for now, that's the way it is. And then somebody asked about KEUA, which is our Europe only. That's the smallest of the bunch. So KRBN is about 500 million. KCCA, which is California, is about 300 million. And then our Europe is sort of sub 50 million. That's a smaller fund. So the question was, is that investable? Now, of course, it's investable. That product's not going anywhere. We are seeing all of these markets having very bright futures and expecting to raise a lot of assets. Then I'm invested in it myself. What to consider though, if you have some liquidity requirement, like you need 100 million in size or X million dollars of trading, then look at KRBN. It's 60% Europe. So if you want the Europe story, but you don't want to buy the smaller ETF, although there's no reason not to, you can buy the blended, which is mostly Europe. So that's a good way. I kind of call that Europe Plus. And then you can complement that with the individual California and Europe. So hopefully that answers that. Somebody asked about our numbers on the European program. So
I think it's in terms of the size of the market, we look at the most liquid contract, December contract, which is the most relevant for large size investors. We can start adding other maturities which are not liquid. That's a little bit less conservative, and that's where some other figures coming from. But we're not including the auction sizes or EEX amounts, just focusing on really the future markets traded in our product. The fund contract.
I was thinking whoever asked it was saying that number sounded bigger than they thought rather than smaller than they thought. But we're taking the ICE traded futures volumes, and like you said, there's more to add to that. There's other exchanges plus the physical market plus the bilateral physical market, secondary market that we can't measure either. So we suspect it's much bigger. That we think it's more like 800 billion in size. So I think someone asked about UK. We didn't cover UK that much on this call. My view is that the UK could be incredibly strong this year. However, it's a 5% weight in our fund, so one of the smaller weights. I think it's quite risky because the commentary out of the UK's rhetoric around this has been very, two-sided. And so I think it could be very strong. I like the fact that we're only 5%. If it does very well, it'll be a very good addition. But it is a riskier market, in my opinion. I think it's got quite sort of, bipolar commentary coming out of 10 Downing Street on it. So I don't know if you wanted to add anything to that, Oktay, but I think it could be very good, very strong, but it brings with it some risk. So I think a small allocation is sensible.
I think that's also the country where the green backlash was stronger and the political will is weaker, so that there's more risk in that market. But again, it could be an opportunity as the regulatory environment turns around.
Great. Well, thank you everybody for your questions. I think we actually got through all of them. And if any more come through, we'll be sure to answer them and get back to you by email. So thank you everybody for joining us. Oktay, as always, thanks for everything you do for these funds and the modeling and the insights. And we look forward to seeing everybody soon and hopefully answer some questions on how to invest. So thank you very much.
Thank you.